It's been a high volatility the entire series gone by, and we've even reached that 17,500 trade. So definitely could do with some amount of relief, when it comes to the March series. But let's see how we kickstart, starting off on a fresh slate with the Nifty higher, just marginally. 17,576 is where we're currently at. Let's see whether the banks are seeing any meaningful recovery or not, because that's the other part of the market which has been languishing. For now, at least on the opening tick, you've got a 0.5% uptick coming in for the Nifty Bank. Axis Bank, after them hoping to complete Citi's consumer business acquisition by March 1st, I can see a green print on Axis Bank. It's good to see that there is quite a bit of relief actually on the Adani group of names, considering these were the ones which really dragged the market lower, or at least the sentiment lower, and dragged a fair bit themselves. Adani Ports, Adani Power, Adani Enterprises, all of these stocks are holding up in the green as we speak right now. What is Zee then up to? And I'm sure there's a big crack there. The stock is going to be excluded from F&O come May, and it's out of the F&O band today. Zee is down 3% as we speak right now. 192 is where the stock is struggling. Remember, the NCLAT is going to be hearing the plea against insolvency today, so this is going to be an important one. Electra jumped up in the pre-open rate itself, and I'm sure it's holding on to the greens even now after them looking to develop the hydrogen bus in technical partnership with Reliance. There's also RVNL after that order win. There's DLF looking to repay NCDs worth 500 crore rupees. There's Alchem Labs as well, which is in focus. The US FDA has concluded the inspection at the Indore unit, and they've issued an EIR there. So these are a couple of stocks which are going to be in focus. And besides that, also what an ITC is up to, considering this was the more resilient of the names like we were just discussing with Kunal as well. ITC a little bit tempered at 386 thereabouts. Now to the pressure points in the market, which of course outside of the Adani group of names, even were Asian Paints, for instance, yesterday saw a crack of 4% coming in. In fact, Asian Paints has seen a long bout of underperformance now, up about 0.6% as we speak right now. L&T was quite a big loser yesterday. It was down 2.5%. Let's see what L&T is up to as well. And then, of course, what ITC is doing and whether it's not scaling new heights or not. 386 is where that stock is mildly under pressure. The breadth of the market, though, has started off positive, and I think that's a bigger relief right now. Kunal, do you think we'll manage to stay on with the gains or even build on to that for that matter?
I think the first half could be a bit tricky because there would be a lot of unwinding of positions, mark-to-market pressure. So I think on the back of all of that, the first couple of hours for trading would be that to square off positions, mitigate risk as much as possible. So wouldn't be surprised that there would be some tripping off of the gains for stocks as well as for the indices. But I think the second half is going to be key because there is a credible bounce in the global markets, and that could probably give an indication for traders to try and carry forward long positions. And if that happens, then probably the second half could be a lot more better than the first half of the day. The stock which I would look to trade at current levels would be Bajaj Finance. That's a stock which I would look to buy. I think 6,200 has been a good strong support for the stock and also forming a bullish hammer pattern on the daily charts.
Okay, I just want to quickly flag off Electra Green Tech as well. That stock has started with a jump of around 11%. Remember, it's the hydrogen bus that they have managed to develop in partnership with Reliance. So let's pull up the intraday chart of Electra Green Tech because that's open with a solid gain of around 11%. You also have Sanofi, which is reacting to its earnings. Well, it was a bit disappointing at the top line level, but the profitability has shown a good jump of around 46%. So that stock is also up around 4%. Reddington, of course, is reacting to that large trade which happened. 24% equity has actually changed hands, and we are checking the shareholding pattern of the company. It's only one, holder of Sensex, Mauritius, which actually holds that much stake. So the expectation is that that is the one which has likely made that sell as well. On the losing side, of course, Mahindra Lifespace is down 6%, so that stock definitely deserves mention. And interestingly, CSC is losing out on heavy volumes at the moment. It's already 3.5 lakh shares which has been traded, and the stock is down about 6%, so we'll track that. But Nooresh, what are the first trades that you are spotting as far as the index and stock-specific recommendations concerned?
So on the index, would wait for a dip. If in the dip we get it closer to 70,500 to 540 band, that's a buy zone. On the stock side, it is HDFC Bank, which is a trade which I expect, which would be a little medium term in perspective, but an accumulation at 1600 to 1570 zones.
All right, let's connect with Mahesh Patil as well, who's joining in, CIO, Aditya Birla Sun Life AMC. Hi there, Mahesh. Good to have you on board. We're kickstarting a brand new series, but there's still a little bit of trepidation in the air with respect to how the markets have fared. The fact that we've seen that underperformance within the broader markets. What's your outlook? Is there more downside in store?
Yeah, good morning. So we have seen some kind of correction in the market, primarily because of the fact that we've seen that the outlook on interest rates after the recent Fed minutes seems that rates could inch up a bit higher than what we were expecting and stay higher for a longer period of time. And that has impacted the sentiment because whether that could further impact growth is what the market is slightly worried about. But having said that, I think overall, at least from an Indian market perspective, we are not seeing any major impact on earnings growth. We have seen this quarter go by, and while the results were a bit mixed, we saw some slowdown in a few sectors. But by and large, I think the earnings growth outlook, even for FY24, still looks to be fairly healthy in the double-digit range. And as a result of that, I think the markets, while the sentiment has weakened a bit, but we don't see much of a downside over there. Market will probably remain a bit range bound and try to consolidate and look for further cues before it starts to move up. So I would say we are in a phase where market is trying to readjust some of the valuation premium which was there in some of the sectors and try to correct that. But I think the medium long-term outlook for Indian markets and the economy still looks fairly resilient. There are a lot of sectors which are now coming up and doing reasonably well. And as you look into the earnings for next fiscal year, it's pretty wide range. It's not like a few sectors which are driving that growth, but it is across sectors, be it the banking sector, the industrials, the capital goods sector, the auto sector, and even the IT sector for that matter, right, which is expected to probably face the brunt of the US slowdown. Again, there also, I think the growth for next year still looks to be, at least the profit growth looks to be still in the double digits. So given that, I would say that the market should probably, while it might not go up in a hurry, okay, it should, downside seems to be limited.
Good to hear that. Mahesh also wanted to understand, given the kind of returns that debt and fixed income is giving right now, are you seeing more allocations to your balanced funds?
Yeah, so this year, I think we have been seeing that not only debt, but the returns across asset classes are in a very narrow range. So whether it is debt, whether it is expectation on gold or real estate. And as a result, I think investors will probably look to diversify across asset classes and try to really reduce the overall volatility. But I think on the debt side, I think with interest rates now, or rather some of the funds giving around 7.5 to 8% kind of a return, there is some amount of flow or interest coming back into fixed income. And we see this year is a year where retail money into fixed income can go up significantly. And to that extent, I think you would see allocation shift a bit from equities into fixed income. And within the overall basket, some of these hybrid funds, which are the balanced advantage fund or the multi-asset fund or the aggressive hybrid funds, could see more interest because the debt part of the component will start to yield now a reasonably good return. So, yeah, so we expect, I think, the hybrids to probably attract more flows in this year.
Hi Mahesh, this is Anish also joining in the conversation. Just wanted to get a sense from you when it comes to the entire capital goods space, the manufacturing, industrial themes. That seems to be a consensus buy at the moment. Do you concur with the view? And if yes, which pockets look the most strongest to you? Is it, let's say, rail? Is it likes of ABB, Siemens, or is it infrastructure, the likes of L&T?
Yeah, so the outlook on capital goods, yeah, I mean, the companies have seen a reasonably good improvement in the order book. Though I would say it is still early days for private sector capex to pick up. We've still seeing sectors like cement and metals where the capex outlook remains good and companies have announced plans. But still a wider private sector capex pickup is probably some time away. But I think we're still hopeful that in the next few years, looking at the government focus on domestic manufacturing, also the China Plus One policy and the domestic growth itself, we should see a revival in capex going forward. And within that, the government spending on infrastructure in this budget, we've seen a significant increase on that, especially into rail, in the railway sector, where you would see significant investment in terms of the rolling stock, and also on defense, where we're seeing a lot of sourcing from domestic manufacturers. So I think it is probably widespread across not only industrials, automation. A lot of companies are now new industries which are coming and are focusing more on automation. So companies which are spread across the space, especially the short cycle ones, and I would say that the industrials and capital goods sector, especially focusing on automation and some of the other new growth areas like what we're seeing in the data centers. There's again a huge investments over there. So those companies would probably see a better growth outlook from a more longer term perspective. Having said that, I think the valuations and some of the stocks are already factoring in the growth. So I think one needs to be careful in terms of the overall further re-rating which could happen in this sector. So it will be more driven by company specific in terms of the segments and order book, what will drive the performance in these stocks from here on.
Mahesh, in the recent decline or the year-to-date underperformance relative to other world markets and especially EMs, where is it that you in your funds have cut exposure or gone underweight?
So, in the initial period when we were looking at the slowdown in the overall global growth, some of the global cyclicals is where we had cut down our weight. But I think now, to a large extent, whether it was IT sector or the commodities or the metal sector, we don't see further downside. The stocks have already corrected. And in fact, over the last couple of months, we would have increased our exposure now in the IT sector. But apart from that, I think our overall tilts across sectors are not very large. Okay, we are not seeing any major kind of an outperformance in a particular sector. There's a lot of sector rotation which is happening. But in the oil and gas sector is another one sector where we have been underweight now for quite some time because we're not seeing any major kind of outlook improving in that sector, and because of the government intervention and policy not being clear, that sector is something which we have been underweight for some time. And besides that, on large underweight would be on the consumer staples, where the growth slowdown, what we've seen last year, especially in the rural, is now picking up, but valuations there are still on the higher side. So apart from that, we haven't really done any meaningful changes on the sector allocation.
What about, the outlook, Mahesh, when it comes to the valuations for some of the pharma companies or FMCG companies? Do you think that given the kind of growth multiples they have, that these valuations are justified? Is it a sector? Are those sectors that you would look at closely?
The pharma sector overall has underperformed the last 1 year because during the COVID period, we saw very strong performance in terms of earnings growth because they benefited from the whole COVID wave. And I think the base effect is now kind of coming down. So we should see a reasonable growth over there. Again, within that space, the domestic pharma is where one would see a steady growth with decent profitability and return on capital. US focused companies, especially the generics or US export, that segment is still seeing a lot of pricing pressure. And we're seeing now new, as US FDA inspection has started now, we're seeing some concerns again coming back in terms of warning letters and stuff like that. So that is something which probably is still weighing down, but overall valuations in the pharma sector are still fairly reasonable compared to the long-term average. So as a defensive from here, I think it can be a good sector to look at, considering that it has underperformed in the last 1 year. So that's clearly on the pharma sector. On the FMCG sector, the valuations, I think in the current market where people are worried about growth and also growth concerns in a few sectors, I think the FMCG probably becomes a good defensive, and that's why we're seeing some interest in that sector. And so the valuations would probably continue to remain higher. Within the FMCG sector, I think the rural economy, which had suffered last year and still is now coming up, I think that could see an improvement going forward in this fiscal year, looking at how the monsoons are and also the farm incomes have started to move up a bit. So that I think can be a within that company which are focused more on the rural side. I think you could see a better improvement in this fiscal year.
Appreciate your time. Thanks so much, Mahesh, for joining in with your take on the markets. Let's move right on and hear it out from the Prime Minister Narendra Modi speaking at the G20 Finmin meet.
Down. We need to collectively work to strengthen multilateral development banks for meeting global challenges like climate change and high debt levels. Excellencies, in the world of finance, technology is increasingly dominant. During the pandemic, digital payments enable contactless and seamless transactions. However, some recent innovations in digital finance also pose risk of destabilization and misuse. I hope that you will explore how the power of technology can be used for good while developing standards to regulate its possible risks. India's own experience can be a model. Over the past few years, we have created a highly secure, highly trusted, and highly efficient public digital infrastructure. Our digital payments ecosystem has been developed as a free public good. This has radically transformed governance, financial inclusion, and ease of living in India. As you are meeting in Bangalore, the technology capital of India, you will have first-hand experience of how Indian consumers have embraced digital payments. In fact, during our G20 presidency, we have created a new system. This allows our G20 guests to use India's path-breaking digital payment platform, UPI. As you make use of it and experience its ease of use, you will understand why Indian consumers have adopted it so willingly. Examples like UPI can be templates for many other countries too. We would be happy to share our experience with the world. And the G20 can be a vehicle for this. Excellencies, I once again thank you all for your participation in this important meeting and wish you all the best for very productive and successful discussions. Thank you.
All right, there you have it. That's the Prime Minister speaking, talking about, really growing India's potential down the line, talking about sustainable development goals, which seem to be slowing down, as well as how he's urging G20 to really focus on the most vulnerable citizens of the world. Let's put the focus right back to the equity markets. At the index level, we're down 0.2%. It's the broader markets which are outperforming. As of now, up about 0.5%. Divi's Labs, Adani Ports, Dr. Reddy's, Infosys, they're some of your gainers. Well, IRB Infra is in the spotlight in trade. They're an L1 bidder for a BOT project in Gujarat worth about 2,000 odd crores. Let's understand the order book visibility, what the outlook is for the company down the line, and what the toll collections could likely look like. We've got Anil Yadav, who's the Director, IRB Infrastructure Developers, joining in on the show. Good to have you on board. Let's start off then with being the L1 bidder for the BOT project. It's worth about 2,000 odd crore rupees, and the company had even stated that the order inflow could be 6 to 8,000 crores in Q4. Will we now see the pace of your order inflows ramping up in Q4?
Thank you. Yes, we have bagged one BOT project worth of 2,100 crores. And there were a total 6 bidder for this particular BOT. And this BOT will get funded 70% debt, 30% equity. And we are expecting that this will get executed through our private investment platform, where IRB will put 51% equity. So our equity requirement for IRB will be roughly 350 crore rupees. And with regard to the further pipeline, I think there are many projects lined up to be bidded till end of this fiscal year. So considering that kind of large pipeline available, we expect good order flow in coming in few months.
Okay, can you quantify that when you say good order flow? What is it that you're likely to pencil in terms of your overall order book, and what's the target?
So as of now, we have a 21,000 crores of order book. Out of that, roughly 10,000 crores is the EPC order book. And O&M order book is around 11,000 crores. And roughly 6 to 700 crores of execution we are doing on per annum basis as far as O&M is concerned. Now, EPC and O&M put together, that is close to 3x of what EPC revenue we have achieved in FY22. So we have order book for 3x as compared to FY22 revenue. But there are many projects are in pipeline, and we will try to bag another in the range of 4 to 6,000 crores worth of project in a space of HAM and BOT.
Sure. You know, your FY23 revenue growth stood at about 15 to 16%, and it was stated by the management when we last interacted. Do you expect this number to touch in higher teens or 20%, say, in FY24? And are we going to see more bidding when it comes to HAM or BOT projects?
So I think with the current order book itself, our EPC business can grow easily 20%. And BOT is expected, the current BOT projects which are with IRB is expected to grow in range of 20 to 25%. So on top line, definitely we will be growing in range of 20 to 25%. And that's the outlook as far as overall revenue is concerned. And if we bag the more order flow, then definitely that will be additional. But based on the current order flow, we will be growing in range of 20 to 25%.
Sure. You know, the other thing I wanted to understand was about toll collections, because across projects we've seen very robust a move with the improvement in traffic as well and the increase in toll prices too. What's the growth guidance that you could give us?
So I think in terms of the toll collection, we have seen a healthy growth across the portfolio. In fact, last 1.5 years, we have seen a high single digit to double digit kind of growth as far as traffic growth is concerned. And if we'll talk about the last January month, we provide the toll collection on the monthly basis. In the Jan month, Mumbai-Pune has delivered a traffic growth of roughly 16%. And if I will take, and that Mumbai-Pune was only on backdrop of the traffic growth because tariff revision happens after every 3 years. And if I will take the IRB and private investment put together, the growth in Jan month as compared to Jan of the last year was roughly 36%. So now the base, I think, is already corrected. Basically, base is already got elevated. From here on, the growth in the toll collection will be on two count. One is the WPI, where December WPI was close to 5%. We expect 5% tariff revision across the portfolio. And plus, the traffic growth will be linked with the national and the state GDP, where the project is basically are there. And considering the kind of GDP growth we will witness, the similar kind of growth will be there in the traffic. So I think 10 to 12% kind of revenue growth on toll side, that is very much doable.
Okay, given that the consolidated debt was at about 12,700 odd crores, it seems to be declining sequentially. What's the company's debt prepayment strategy for FY24? Any ballpark target that you're looking at in terms of a number?
I think as far as the consolidated net debt to equity is concerned, we are a 0.8, less than 0.8 is to 1. And going forward, as per our strategy, whatever the BOT project will be there, that will get executed through a private InvIT. Private InvIT is a joint venture, and there is no the private InvIT does not get consolidated with the IRB. So whatever the debt will be taken for in the private InvIT, that will not get consolidated with the debt of IRB. And as far as strategy for the HAM project, as and when HAM project will get completed, that we will sell those HAM project. We will monetize those. And in that, in line of that particular strategy, we have already monetized the VK1 HAM project and realized roughly 342 crores rupees for the equity portion. So considering that there will not be increase on account of BOT, not on account of HAM, and there will be continuous repayment on the asset which is with the IRB like Mumbai, Pune and Ahmedabad, Vadodara. So on a continuous basis, there will be a debt will be on a declining trend, and the net debt to equity will be keep on improving.
You recently received the appointment date for Ganga Expressway project as well. As some of these large projects now move into execution, could you share with us the important timelines for these projects and by when contribution of the top line can be seen from the EPC segment?
So I think on the EPC segment, the contribution has already started because the appointed date was in previous quarter. And now, if you look at the overall order size of Ganga, that is roughly 5,000 crores plus. And if we have to complete this project within 3 years. So if I divide simply by 12 quarters, so I think on quarterly basis, this should provide a revenue 500 to 600 crores of per quarter basis.
Time out and joining in and giving us a sense as to how things are shaping up. So order book at about 3 times the revenue as of now, and a 20 to 25% top line growth is being penciled in. All right, from one corporate voice to another then, and we've got Landmark Cars that is in focus. Are we seeing recession woes hitting luxury demand? What is the outlook on the company's major tie-ups as well as their margin trajectory? Sanjay Thakur, who is the chairman at Landmark Cars, now joins in. And Sanjay, I'm just going to jump straight into it because the buzzword clearly seems to be recession. And when it comes to the auto industry, very closely linked to the economic growth, what's your outlook on ground as things shape up right now? Has there been any impact when it comes to luxury demand, or are things going on as per usual?
Touch wood, things are going on as normal as of now. There is no letdown in the demand as far as luxury cars is concerned. And because the base is so low, I was talking to somebody and I figured out that only 5% of the dollar millionaires in India buy luxury cars as compared to 60% world over. So there is a significant elbow room for us to grow. There is a long path for this secular growth. That's the view we are having, and I think the good times have just begun.
Now, let's just understand a little bit about the financials as well. Your after-sales service is highly profitable and that has seen a smart growth over the years. What kind of contribution is it to your total revenue pie, and how do you see the after-sales services segment growing?
Yeah, so the after-sales and service, and that includes the accident repairs. Now, accident repairs is a very interesting stuff. 1 in 3 cars that you see on the road comes for some or the other body paint work every year. Now, this is a recurring kind of a business. The after-sales and this repair business has grown at 20% CAGR for us for the last 9 years. And it continues to be a 40% gross, 18-19% EBITDA margin business. So this, my sense, is like an annuity type of a business. And that is very, very predictable. Not at all cyclical in nature. Recession or no recession, this will keep on happening. So we are bullish on it. We have also added some car care product brands to kind of increase our per throughput revenue, which has also seen a significant jump over the period of time. This year, we will be servicing upwards of 3 lakh plus vehicles. So this is the bedrock of what we do. And on top of it, you have the finance and insurance income, you have the car margin. So it's a pretty decent business that we run, I guess.
You know, that's the other thing, Sanjay, that, you know, what you were saying in your previous answer as to how this is just such a low base business. Wondering when you're going to see that big expansion take place when it comes to how many people in India actually buy luxury cars.
So, I mean, just to get a perspective as to how low the base is, for say a Mercedes-Benz which sold just under 16,000 cars last year, China in a normal year would do 7.5 lakh cars. So we are clearly 2% of what they are. And really the discussions that we are having is that whether it will become 30,000, the plant capacity is all there. In a few years, or how many years is it going to take? We haven't moved much from this kind of a luxury segment which has stagnated at 40,000 or under for 6-7 years now. I think this is the year where we will decisively break out of this, and the upward journey will continue for hopefully a few decades.
But within the luxury segment as well, is it Mercedes which wins hands down?
Yes, they do. So it's been several years running that it's been a #1 brand, and I'm sure we will keep it there.
Session for Mark, isn't it? But tell me, you know, since you are talking about perspective and numbers, stack it up with China, Germany, and I'm not even touching the US geography. What are the numbers that they deal with when it comes to luxury car market? I'm sure the number is like maybe 10x or 20x.
No, in absolute numbers, it clearly is. But out of the total market that we are talking about, we said we sold approximately 4 million vehicles in India, 40 lakh cars last year. The luxury segment was under 1% of the overall sales. Now, this number is 7-8% in China, high double digit in America. So people and that aspiration level is happening. We also are seeing a lot of road building in India, and there is a direct correlation between the roads that are built and cars that are sold. So once the roads are all in, and people also travel intercity, we have seen a lot of opening of highways by the Prime Minister, and the government is doing a lot towards building good quality highways. So people will travel long distances or at least mid distances interstate. And that's where the demand for premium and luxury cars will shoot up. This is where people would want to buy better and more safer cars. So all in all, we have a good concoction kind of brewing right now. And it's the journey is up. The question, as you rightly asked, is how fast?
Yeah, but while you spoke of, you know, Mercedes-Benz, we also understand that they've now moved away from the conventional dealership business model to the agency model. So revenues from the cars sold would not be a part of your books, as we understand. So what could be the outlook?
So what we have done for an apple-to-apple comparison is that we have kind of shown it as pro forma revenue. Because the number of cars that we sell and the value we get a commission on. So otherwise, it will look that our margins are flattish or down, but our turnover is flattish or down, but our margins have shot up. So that's not exactly the case. So for better understanding, we have been reporting it as pro forma revenue, and which will show that we have shown a very healthy growth in the 9 months. Some 41% growth is what we have clocked, and we have surpassed our profitability for the whole year. Save and except the one-off write-off that we have done.
Okay, fair enough. I just want to go right back then to your financials. While we did talk about your after-sale services, your EBITDA growth as well, over the past few years, the performance for the 9-month period is at about 7.4%. How much headroom are we seeing here?
See the growth for an auto dealership, and this is something which is because we are the only listed dealership chain, and people really don't know how to look at it. we are just 2 months that we have got listed. Over a period of time, people will realize that we do different things. Some of them are so predictable that they could be looked at as annuity businesses, and some like a finance and insurance is 1% of our pro forma turnover of sales. That is straight pass through to the bottom line. The growth will be, and as I said, for after sales, 20% is what we have been growing for last 8-9 years. I don't think that we will let that down, and it will only be there or increase. The OEs that we are partnering with, the average selling price has gone up of the vehicles that we sell, and they are all likely to outperform the industry this year. So you will have a very a nice mixture of growth and profitably increasing in the years to come.
Good to have you then on board, walking us through the outlook on Landmark, how your financials are shaping up, as well as the kind of recoveries, vehicles that you're servicing, as well as what the outlook is. Clearly, categorically saying that there's absolutely no slowdown when it comes to the overall luxury car market. All right, let's get a move on then. And we understand that India is set to get a brand new social stock exchange through the NSE. What exactly does this mean for India's growth? And that's what we're trying to simplify and we're trying to explain in this report. Take a look.
Now, India is set to get a brand new social stock exchange, and this through the National Stock Exchange. What exactly does this mean for India's growth? And that's exactly what we're looking to explain today. The National Stock Exchange has received the approval from the Securities and Exchange Board of India, SEBI, to set up this social stock exchange. The exchange is going to function as a separate segment from the 22nd of December 2023. But what is the purpose of this new stock exchange? Well, non-profit organizations can now list on the National Stock Exchange and raise funds. It's in line with the Finance Minister Nirmala Sitharaman's vision to create an exchange for social enterprises and voluntary organizations to raise money for their causes. Now they can raise funds through equity, through debt, and through mutual funds. The not-for-profit organizations, they would issue these zero-coupon, zero-principal securities to raise funds, the ZCZP securities, like we know them. So what are the intricacies of raising funds through this exchange? At present, the prescribed minimum issue price is 1 crore rupees, and the minimum application subscription size is 2 lakh rupees. So according to the National Stock Exchange, trading is not permissible in the ZCZP kind of category when it comes to bonds, but it can be transferred for other purposes, such as the transfer to legal heirs. So another question is, who is eligible to raise funding through the social stock exchange? Well, this exchange identifies non-profit organizations and for-profit organizations as social enterprises. To be recognized as a social enterprise, organizations need to demonstrate that 67% of their activities have targeted underserved or less privileged population segments or even regions that have recorded lower performance in the development priorities of either central or state government. So this brings us to the other big question: who can invest in these instruments on the social stock exchange? So as per the NSE circular, institutional and non-institutional investors can invest in the securities issued by the social enterprises, while retail investors, they are allowed to invest only in securities issued by for-profit social enterprises. Foreign investors are currently not allowed to invest through the SSE. While this is still a new concept in India, many countries like the United Kingdom, like the United States, Brazil, Canada, they already have such investment platforms that have helped social organizations raise funds. And India too is hoping that such platforms can help bring in investments to social enterprises.
Well, the banking index is outperforming today, at least for the moment. It's up around 100 point, while the Nifty actually is up just around 30 points. So yes, we're off the highest point of the trading session, but still, as compared to the frontline index, at least the momentum seems to be better when it comes to the banking space. Let's take a look at the mid cap and the small cap indices and see what they are doing. I think they're pretty much in toe to toe with what the frontline index is doing as well. And the advance decline ratio is also evenly split. Just wanted to flag a couple of stocks. KSB Pumps is reacting to the earnings, so that's up around 7%. There's a sudden spike which is visible for India Bulls Real Estate, so that stock is up around 8%. Sanofi is also result reaction coming in. And for Aarti Industries, there was a recent commentary that came in from the management talking about the outlook, which was quite positive. And then a couple of these textile, retail sort of companies, TCNS Clothing, Alok Industries, etc., are also buzzing in the trading session. So a lot of movers, at least in the broader market. And quickly, let's check what the Adani group of companies are doing. Well, Transmission, Total Gas, Green, they continue to languish. It's a down circuit of 5% yet again. And Hindalco is an interesting one because that's down over 4%. And some other metal names like Jindal Steel, etc., are also coming under pressure. NMDC, of course, is the candidate for going ex-dividend, so there's a technical adjustment there. But metals as a pack are not shining, at least at the moment. But then what's shining and what could shine for the rest of the year? We asked this question to Vikas Prasad, the portfolio manager, Asia Equities, M&G Investments. He sees no weakness in the IT space, but is cautious about the positioning of the private banks.
If you look at IT services, the larger companies, it's not as bad as people think. If you listen to the commentary, if you look at the numbers, revenues are healthier than people thought. Margins are higher than people thought they would be. Banks is one area where we prefer some of the smaller and middle-sized ones, specialty finance, housing finance, not so much the big banks. The scale is such, you have to be more careful.
It's interesting that you say IT is not as bad. So clearly you're not concerned about US recession. You feel that that's going to only spell more business for India services?
I think it's fair to say we were more concerned about that 12 to 15 months ago than we are today, and the portfolio is positioned for that. Also, the prices reflect that. So if you look at the starting point today compared to the end of calendar 21, the starting point is so different. And there's a lot, what we're trying to judge always is what is in the price and how do we allocate our capital to maximize prospective returns. You look at IT services over the past 15 months or so, and a lot of those concerns are in the price. Now you start looking at the numbers, and relative to expectations of just 3 to 5 months ago, the earnings delivery has actually been quite positive across the sector and concentrated in the larger ones.
What intrigues me on the other hand is, and sorry to jump to not what you don't like, private banks. What makes you so wary of private banks?
I think it's less an absolute concern about the banks, more just a relative positioning and where the relative returns are. So I think if you look at the size of the loan books and the growth that is priced in for them, in percentage terms, these numbers are high, but in absolute terms, it's so large. So where we see better opportunities, not that we don't have good opportunities, we have good opportunities. Where we see more and better opportunities are in some of the smaller companies, housing finance. If we look at housing finance for the lower and middle income groups, I know there are some sectors in consumer discretionary, consumer staples, where if you're exposed to the mass market, there's some concerns, and we can talk about that. But in housing finance, I think that's a very long-term story for growth, and we have our capital there.
Well, how can you be bullish on India and not bet on the big banks, right?
Yes. So it's more a relative bet. So if we look at the aggregate exposure in the big banks that we have today, relative to the rest of the portfolio, it's a little bit smaller, but it's still quite overweight. So we still like them, but we like other things more than we did a few
More the
months back.
corporate-facing banks?
More the corporate-facing banks, yes.
Okay. And I'm going to now jump from IT to the sort of, the fancied IT names, all these tech companies, the new age tech companies, so to speak. And I recall your comment that, you weren't as smart as an Alia Bhatt or a Katrina Kaif and you actually skipped Nykaa.
Yes.
But in retrospect, I'm sure you feel happy about giving those names a skip. Having said that, now that they seem to be on the path of profitability, talking it, delivering it, as did a Paytm, are you now exposed to them, or is it still zero exposure?
So our aggregate exposure to the class of 21, class of 22 tech IPOs is still effectively zero. You can have an issue with a company's valuation or the business model itself. For us, for many of these companies, the issue was not the valuation, although it was that also. The primary concern was the business model itself. And in a world of rising competition, pricier capital, what do these companies do? How do they evolve? And what we've seen in the earnings delivery, or there's not much earnings, even in the revenue delivery, is that our concerns have been justified. And despite the correction in the share price, there's not much value there yet. So there's a small subset of these companies that we keep our eye on, but our aggregate exposure is still effectively zero.
None of it? No Policy Bazaar, no Paytm, no Nykaa, or maybe the unlisted space as well?
Well, so I'll talk about the unlisted space,
Sure.
because I think there are certain areas in B2B e-commerce, in infrastructure build-out, in manufacturing, and in two-wheelers, where we are actually quite excited. Our allocation to new private companies in 2022 was zero.
So India you continue to remain bullish on at large, but ex-India, just at a global level, which is looking like the most exciting market, considering you don't only invest in India but across the world?
I would say Japan in Asia, if we confine ourselves to Asia.
Sure.
When I look at the region, the geographic bookend, so South Asia, India, North Asia, Japan, I think those are the two equity markets with the longest tails to growth. Totally different markets, totally different drivers, but we are very excited about those markets. Greater China, our answer is the same today as it was midway through last year and 2 years before that. When we get asked, is China investable, are you excited about China? The China story is not going anywhere. We remain actively invested in China. Last year, we increased our allocation of capital to China, and it's an area where we continue to find opportunities. And so again, to go back to that June, July, August, September period last year, when there was such skepticism about China, that was a wonderful time to have been already focusing on China. I think if there's a looming sell-off in India, and this slight underperformance is not what I would categorize as a sell-off, but if it is looming, then I think we will have been rewarded for having been spending so much time on India. The fact pattern is very similar. The economies out here are large enough and they're diverse enough that they don't rely as much as they used to on the US consumer. There's still a lot of reliance for manufacturing, apparel in some sectors, but it's not as much of a reliance. Now, to answer your question about the recession, I think a lot of that was priced in last year. The rising cost of money, the rising probability of a recession. It's not something that I think about as often anymore. The price of energy and the price of labor, you can't entirely disaggregate that from the price of money, but rising interest rates and the price of money, these are things I spend less time on this year than last year. So there's a lot in the price. It's a very important market, but I think there's so much going on domestically in each of these key 4 markets that we talked about and in others that there's a lot of opportunities for investors.
IT, Kunal as well has been pretty bullish on Tech Mahindra. Kunal, that's the chart buster.
Well, yes, Aisha, and I think it's very interesting because the stock is showing a classical rounding bottom pattern breakout. So as you can see that the stock has been forming over the last 6-7 months from the June lows when the stock was almost at sub 1000 levels towards a point where the stock currently is on the verge of a breakout. Now what's interesting about the chart is the pattern which you can spot on the volumes, that over the last maybe 1.5 odd year, the stock was getting into a band where the volumes were dropping down significantly for Tech Mahindra. This is the average volumes that the stock had seen in the phase of consolidation. Now all of a sudden you see this breakout candle for the volumes, the stock moving up into a zone from the lower end of this channel pattern towards the higher end of the channel pattern, and this in effect would probably trigger one of the breakouts for Tech Mahindra. I believe possibility of another 150 point up move from this 1150 zone of consolidation is a very high probability for Tech Mahindra. So I'm expecting from this 1150 mark the stock to climb towards at least 1300 in the matter of the next 1 to 3 months.
That's a take coming in on Tech Mahindra. Definitely bullish patterns is what you can see on the charts of that particular counter. But Nooresh, your take, which is the chart buster idea that you are spotting?
So that's a long-term chart for Wonderla. Now the stock had a lot of promise when it got IPO'd way back in 2014-15. And at that point of time, it made a top around 430 levels in 2015-16. Even in 2017-18, that was the top. And corrected almost to 120 in the COVID lows. And has now finally made a comeback towards the 430 mark. Did so a few months back. And now we are back at 430. So this indicates it's a 8-year breakout. So such a breakout should see a good move over the next 3 to 6 months. A period of accumulation at 420 to 445 is what would be suggested. A stop loss at 400 and a target price of 550 to 600.
Get some other stock specific recommendations and money making ideas as well from our charters. Kunal, you go first.
So Bajaj Finance, a stock which we discussed in the morning, that's a stock which I would rate it as a buy. again forming a classical bullish hammer pattern, showing strength so far. So would expect this momentum to continue for 6,400 for the stock. Stop loss remains at 6160 mark. And Bata India is the other stock which I'm expecting that the stock would probably get into a bottom formation process. 2 days of strong price action from 1400 to 1420 plus. Would expect this momentum to continue. 1495 as a near-term target. Stop loss at 1385.
Nooresh, what about you? What are the sectors and stocks that you are recommending? Sticking to the large cap names, I believe.
Yeah, so first is a buy on HDFC Bank, which is more like a risk reward trade here. Stop loss at 1560 and a target price of 1720. Second is a buy on Gale India, which has clearly shown momentum over the last two sessions, setting up for a much bigger move towards 115. A stop loss at 97.
So much. Those are your chartbuster ideas. Let's move right on then. And ET Now was the first to tell you. And now it's the news break that has been confirmed. The Ministry of Corporate Affairs has approved the revised demerger plan of SCI or Shipping Corporation's non-core assets. My colleague Prakash Priyadarshi joins in with all the details and what it means for the company. Prakash?
Yes, sir. It's a confirmation of our news break as Ministry of Corporate Affairs has given final approval on revised demerger plan of Shipping Corporation of India's core and non-core assets. SCI has confirmed that it has received final approval from the Ministry on revised demerger plan. Remember, company had some apprehension on original demerger plan of its core and non-core assets. Taking into consideration, Ministry had invited comments from all the stakeholders and completed final hearing last month. But today, it has given final approval on a revised demerger plan. Under this plan, a new firm, Shipping Corporation of India Land and Assets, will handle non-core assets of the company. Also, rupees 1,000 crore will be transferred to the new firm under a revised plan. It will also pave the way for the divestment of Shipping Corporation of India going forward. DIPAM will start process. Back in December 2020, DIPAM had invited EOI for the company, but it was struck due to pending demerger plan of the company's core and non-core assets. However, divestment anyway likely to be completed in the financial year 2024.
All right, thanks very much then, Prakash, for giving us all of those details. After flaring up in yesterday's trading session, you've got the stock price of SCI that's somewhat quietened down in trade today. But let's connect then with Mr. A.K. Gupta, ex-CMD at Shipping Corporation, to just talk a little bit more about the outlook on valuations in the demerged entity. Thank you so much for taking time out. To begin with, what in your outlook basis this demerger could be the potential valuations?
Good morning, ma'am. Yeah, this demerger was inevitable. All I would say that this investment has taken a long time and maybe the investors lose interest. But now finally everything has been done. But as you said, looks very challenging whether they can do it by March 23. Now the disinvestment will go into the year 23-24.
But do you believe that 2024 at least could be that FY24 is a likely timeline that they'll be able to finish this? And what are the next level of approvals you believe is likely in this process? Because the MCA approval is out. The next process would be perhaps demerging it and then listing it separately. What timeline do you think all of this will take?
I think they should be able to achieve it in next 1 or 2 months. It should not, as I said, it is already delayed and we should not delay it further. And maybe Deepang will ask for another round of expression of interest, because when in December 20, EOI was asked, maybe the investors were not very clear about this demerger of core and non-core assets. So I think that time when investors had bid, we don't know, we don't have clarity how many had bid. It has not been officially shared, but these are all speculations, whether there were 3 bidders or 4 bidders. But whosoever it was, surely the investors must have tied up their finances and all, and this has been a long time, and they will have, and there will be an impact of division of core and non-core assets. So there will be a rethinking. They will need some time to do their maths again.
But when you were at the helm, and I'm sure these discussions were still on perhaps at that time also, what kind of interest had you seen from the investors? And would you have a sense in terms of which are the assets which are actually getting demerged and what's really in store for the buyers then?
See, one is the core asset, other is the non-core asset. Core asset is the ships, which are moving assets, which is the real business. Non-core is basically the real estate. The major thing is our shipping house at Nariman Point. Then we have our Maritime Training Institute at Powai. Then we have so many residential flats, right from Malad to Worli, Pedder Road, Colaba, and Cuff Parade. So these are the non-core assets which are not part of the business. Shipping house and the Maritime Training Institute premises, as per the agreement with Maharashtra government, they cannot be given to a private party. That's why I said these two cannot be part of the deal. Especially the shipping house, it is very strategically located, very close to Vidhan Bhavan. As far as investors' interest is concerned, I think still many of them are interested. They need clarity, and now the clarity has come. And as I said, they will start calculating, doing their what they are going to bid. They are going to tie up the finances. I just hope and pray that some Indian entity who should be the leader if any consortium is going to bid. SCI must remain in hands of an Indian entity. That is what I wish and pray.
Mr. Gupta, do you think there could be a piecemeal sell-off happening? As you said, there are so many different types of assets available. Instead of, let's say, going to one party, do you think it can be, let's say, one land parcel gets piecemeal to somebody else, the institute goes to somebody else? Could that be a possibility on the cards as well?
See, Shipping Corporation of India is basically tanker-dominated company. Though in 1961, we started as a general cargo vessel company. But over the period, the transformation started somewhere in 70s. And in 80s, we dominated the Indian crude import. And to some extent, we are still dominating the Indian crude market. Well, still, SCI has got a majority fleet is tankers. And as you know, the tanker business presently is really on fire. It is booming, I would say, since last 1 year, at least for 8 months. So all the investors, the buyers will have a lot of interest. The Ukrainian war has created geopolitical imbalance, and with the Russian sanctions coming, the tanker market, both clean and dirty, the freight rates are very much going north, and investors must have. This will definitely interest the investors.
Thank you so much for joining us today and helping us understand how exactly this demerger could pan out and what could be in store for the investors as well. Appreciate you joining us on the show. But time now to slip into a very short break with the news that the market is holding up okay. It's not a runaway rally that we are witnessing, but at least 17,550 is being maintained.